Welcome everybody to SKC Office Hours. I'm Sarah Krom, Managing Partner of SKC & Co. CPAs. I've got just a few housekeeping items for the next hour that we'll be together. This session, as all our other sessions, is being recorded, and so you'll get an email next week with a link to the full video, and it's also going to live in the resource section of our website. So if you want to refer back to it for any reason or share it with a colleague, please feel free to do so. As always, we want this to be as valuable to you as possible, so please feel free to put questions in the chat. We'll work those in throughout the presentation, and if we, for some reason, run over and can't get to them, we'll make sure to include those answers in that email that you're going to be getting next week as well. So today, I'm very excited because the topic is something that our clients talk about a lot. Working with business owners, we have a tremendous amount of our clients that have the value of their net worth tied up in their businesses, and talking about retirement or talking about an exit strategy is something that comes up very, very often. So today we have Valentina Midura, who is the Senior Managing Director of BDO Capital Advisors. I've seen her present several times. She is a powerhouse of knowledge and experience, and I'm so excited to have her with us this morning. Welcome to you, Valentina. Thank you for joining us.
Thank you for the introduction. That was very kind. And I'm so grateful to be here this morning.
So just to give a little clarity to the audience, the CPA firm BDO has an alliance program that SKC has been a part of. This is now our second year. There's a host of benefits for us being involved with the alliance, as well as bringing some resources to our client base. That's essentially how I met Valentina, and this is just an example of that resource working for us as not only a CPA firm, but for our clients as well. So Valentina, on that note, if you wouldn't mind starting by giving us a little bit of background into what BDO Capital does, how it, give us a rundown of what it does for businesses in the marketplace and where BDO sits from the rest of the sort of capital investment banking world, if you will.
Sure. So we are a full service investment banking firm. So we are separate. We have that, kind of Chinese wall between the rest of BDO and BDO Capital. We actually co-founded the practice back in 2002. So I've been here about 24 years. And as a full service investment banking firm, we offer sell side services. So if you were looking to sell your company, buy side services, if you are looking to add acquisitions to your platform, we'll do leverage recapitalizations, which is working with an exit strategy with a private equity firm. We can raise capital. We do fairness opinions. We have an ESOP practice, a restructuring practice. So we really do have a broad set of services, but very similar to a traditional investment banking firm. The exception is we don't have a balance sheet, so we don't provide capital. We can go out and we can secure capital for you. And we don't have sales and trading and those sorts of things that like a Goldman Sachs would have. But typically, if you consider your middle market investment banking firms and really just working with privately held businesses and family-owned businesses to develop an exit strategy. So we don't presuppose that we know what a client is looking to do with their business. What we're trying to understand is, what are your objectives for the business? Are you looking to transfer your wealth to, family members? Are you looking to exit the business within a few years? What is your objective? And then we're trying to align an exit strategy that will meet that objective.
And that's so important too when you talk about the relationship aspect of a transaction of this magnitude, not only possibly in dollars, but in the impact that it has in a business owner's life, is having that relationship and really someone to understand that yes, this is a transaction, but there's people behind this transaction and there's impact to those people, and getting to the point where you really understand what their goals are, I think is something that sets you guys apart from maybe some of your competitors.
Yeah, our managing directors, all of us have been doing this for 20, 25 plus years. I actually think it's an incredible honor to work in the middle market, because if you think of larger investment banking firms, typically those businesses, they've transferred ownership. So now you're just working with a CEO that may own, 5 or 6% of the company or less. It could be another management team that was brought in by the private equity firm. We get the fortunate experience to work directly with the founders. So, my typical founder started his or her practice, with $500 in their back pocket. They struggled for the first 20, 25 years of trying to create this business. And, through very hard work, having tremendous relationships with their customers and developing something that was very unique in terms of a value proposition to their customer base, they've created this business, and now it's time for a liquidity event. So it's funny because I try to impress it upon our junior staff, when they start working, it's just a job for them. And that has definitely changed for me over the time that I've been doing this in my career. It's not just a job, Sarah, it's exactly what you said. I mean, this is the one and single event that a business owner will have that will have the greatest impact on their entire life and perhaps generations within their family. And so it really is, it's establishing a relationship with that business owner. And sometimes, people will say, if I'm pitching on a deal where I'm going up against other banks, they'll say, well, why should I choose you? And really my answer to that is, we have to have a chemistry with each other because we're going to be living together for the next 6 to 9 months. And if you don't believe that I can create a successful outcome for you, I should not be your banker, right? Because this is it. This is the one shot you have. And Lord knows we don't want to do it a second time. So let's create a process where we do it right the first time and we have a very successful transaction coming out of that. I'm very proud to say that about a third or maybe even higher than that of the deals that I work on are past referrals. So I've just had such a fortunate experience with the clients that I work with and the relationships that we've built. When they do refer me to other business owners, I really see that as, just a testament to the experience that we had and the success that we had, as a group. And that includes not just me as a banker and the client, but their tax advisor, their accounting advisor, anyone else that was involved in that process, because it does take a village.
Yeah, it absolutely does. And listen, we always say at SKC that a referral is the greatest form of a compliment that you can give us. So
Exactly.
yep, exactly. So BDO has been basically the leader in global corporate finance. I think you guys were #1 last year in the whole world, and I think #3 just in the US. Is that am I getting that statistic correct?
Yeah, so that's all transactions across all of our service lines within corporate finance.
So what statistics do you have that you can share with us about the successes that your team has had, say, in the last 9 months or in the past year?
Yeah, so if you look at the number of deals that we've closed, I guess in terms of success, when we sign up a client, we don't have a particular large group, about 100 professionals, throughout the US, and our investment banking practice is about 30 professionals. So when you think of us taking on a deal, it has to be the right deal. We have to be confident that we can be successful in that deal. Whereas larger investment banking practices, they have so much staff that they might take on deals just for like the retainer fees. We're not doing that. So of the deals that we signed up, I think we had about 10 transactions in the market last year. We closed on 8 of those. 2 of those just got put on hold. I actually had a call with one of the deals that got put on hold yesterday. It's a marine contractor down in Florida. And we went to market. We did deliver them offers within the range of value that we had originally proposed to them. They have some non-operating shareholders that make up a majority share of the company, and then they just decided that they wanted more value. So we said, that's fine. We need to grow into that value. So let's put the deal on hold. And we're probably taking that company back out to market in December when they kind of grow into a larger EBITDA. But I would say that our success rate is it's got to be upwards of 95% or more. We are able to transact a deal. I think how that starts off is when you meet a client. As I said, understand their objectives, what's important to them. understand whether or not you can deliver on those objectives. And then we always value the company so that we have an alignment on what we believe we can go out to market and secure. I will say in most cases, again, assuming reasonable valuation expectations, we're trying to exceed those expectations. And that's what's happening, I would say, in probably 90% of our cases. And that's through a competitive process, which we'll touch on later on in the session. But it really is just making sure that there's alignment as to what they're looking to get out of a transaction, what we can deliver on. And then ultimately, I always say to them, you have a lot of different options in a deal. One of those options is to hold on to your company. So when we do sign up a client, I want them to always understand that this is your only business, hopefully. I think it is usually. And you have at any point in this process the right to terminate the process or just decide that you don't want to sell the company. And I think that optionality, along with their other options, whether they're selling to a financial sponsor, to a strategic, or maybe they're just doing a minority sale, I think that optionality empowers them and they feel very comfortable with the ultimate transaction that they decide to go down on.
And I think that's important to highlight that you just said we had 10 transactions for the year, 8 of which closed, right? So think about that in ratio to the number of professionals that you have within your organization. You're certainly delivering white glove service and very customizable sort of concierge service, if you will, to your clients, because you're doing such a good job with the vetting and the due diligence component before you even onboard them or consider taking them on as a client. And I think that again is another reason that sets you guys apart from your competitors.
Yeah, I think that also it's a great point. It led me to kind of another point that I probably didn't mention earlier, but we're fortunate at BDO Capital that we see a lot of our deal flow from the Alliance Network that you talked about, and then from our BDO partners, across advisory or tax or other service lines. So as managing directors, our marketing is through to those channels. We're not going out to trade conferences and trying to secure deal flow. So I would say that 80% of my time is spent working with my clients. 20% is spent marketing. That's actually the reverse of what you would typically see in investment banking practice. So what you would typically see in investment banking is the managing director comes out, sells the work, and then you probably see them on 1 or 2 calls. It doesn't happen like that in our group. We have probably 3 to 4 staff that work on a deal, and I am the primary point of contact. So, like myself, with the other managing directors, with all the experience that we bring, we're making sure that something doesn't fall through the cracks on a deal, right? We're on those calls with all the buyers. We're making sure that we're available 24/7 for our clients. So I always tell them, my cell phone is on all the time. Just call me whenever you need me. And we are a little bit of investment banker, priest, psychologist, divorce attorney sometimes. We wear a lot of different hats, but like I said, it's a relationship that you have with your client, and it's a great one. It's a great one to have.
So I'd love to walk through a case study, and I know you've prepared one for us, because I think it's important to showcase for business owners who, again, they understand that their liquidity is in their business, and they understand the need to maximize that, again, whether it's for their own retirement or for generational wealth, which you referenced before.
Yeah.
But the benefit of working with a professional such as yourself and your team is exponentially better than going out on your own and trying to do this because some competitors in the industry, or some friends who sold to a big national, whatever it might be. And there's nothing wrong with that, and I understand that kind of is the beginning of the kicking the tires, if you will, so that business owners get a sense of, well, what I think my business is worth X, and so sold his business for Y. And those conversations kind of start to happen, I think, as business owners get to, I'll call it the last 5 to 7 years of what they want their runway of working in their business to be. But there's such a capability when you engage with a professional to capitalize not only on the dollar amount that you're going to potentially get out of this liquidity event, but also the overall experience of it and the different nuances that go into a deal that, I'm sure you can leverage the case study to explain some of that. But I think it's important to kind of highlight that throughout this case study to show, listen, this does not have to be, the seller and the buyer on opposite sides of the table. Bringing in a professional who's got the decades of experience to do this is really what's going to be what's best for your business and best for yourself and or your family in the long term. So I will turn it over to you. I know Brittany has the slide presentation up just to kind of go through a few slides on this, and take it away.
Yeah. I guess one thing I will say is I think it's even more important to have a banker when you're working in the middle market than, if you were in the bulge bracket, you're talking about sophisticated management teams working with sophisticated buyers. That is not what's happening in the middle market. And I'll kind of dive into a case study in a moment, but a couple just anecdotes I would probably offer out. So in the middle market, you're working with business owners that are tremendously sophisticated in running their business. They're, I think of some of the business owners, and one of them is, the owner of this this company I'm going to talk about here in the case study, but just brilliant, right? What he was able to do with an industry and transform an industry far beyond my pay grade or intelligence level. But what he was not experienced in was doing deals, right? Because, if you think about the 10,000 hour rule, you really have to put in 10,000 hours. I'm putting in my time into mergers and acquisitions every single day, 7 days a week. And that's what he was doing for his business. And so I think where you have unsophisticated sellers, they can get taken advantage of. And 50% of my deals are with sellers that tried to sell a company on their own. It didn't work out. So either the buyer walked or the seller ultimately concluded that they didn't want to do the deal with that particular buyer. That's a lot of investment that goes into that. It's time, it's money, it's emotional strain. As I said, you only want to do this once. So I think what a process affords a seller is there's certainty that you're going to get a deal closed. So that's the first thing. There's certainty that you've maximized the price and structure. And then there's certainty that you haven't been taken advantage of at any level, whether price is just one economic point in a deal, but there's all sorts of different structural components that go into deal making. And I think that's what is helpful for business owners to understand. I'm actually working with a business owner right now. We're in the process of getting engaged. He's actually based in your neighborhood, right in New Jersey. And it's about a $3 million company. They do mechanical, electrical, and plumbing engineering, which incidentally is an incredibly hot space right now. So if anybody is in the services area in HVAC or plumbing or engineering or electrical, I can tell you that those are the highest multiples that you're going to get in the next few decades. But some of the questions that he asked me was, what happens as we go through this process? When will I know if I have a deal? Or what happens if I don't like the buyers that you've brought to the table or we've gotten bids from? And what I tried to assure him of is that there are points in the process, and I'll talk about this as we go through the case study, where if for whatever reason as a business owner, you just decided this was not the right decision, you could terminate the process. And we respect that in our clients. It's never happened to me because I think we give people enough knowledge of the process that they feel very comfortable at each step in the way. But that option is there for you. And then he also talked about finding the right buyer. And as I go through this case study, I'll talk about how we identify the buyer universe. But finding the right buyer, it takes a lot of time. So when you think about a buyer approaching you, that's probably one of 150 buyers that could view your potential company as an opportunity for purchase. And by the time it goes through the whole funnel, there's probably 2 or 3 left standing. So to think about all that diligence that takes place and the number of buyers that you can go down the wrong path with, I think that a sales process assures you that that won't happen. So with that, then maybe I'll dive into the case study and I can kind of talk about some of these points as we go through it. So
And
Brittany, this one,
I
oh, sorry.
think, no, that's okay. I think that word process is really important in this situation because you've developed that process and you have that process. You referenced the 10,000-hour rule, right? You do this day in and day out. And not only have you systematized the process of the due diligence and the vetting and all that piece on what buyers are potentially coming into the funnel, but you've got a more extensive reach to begin with than the Main Street business owner may have on their own. And I think that's important too, because you're pulling from a broader audience of potential buyers, which gives a better likely outcome.
Absolutely. And I will, as we go through this, I will kind of talk about how we identify that buyer universe. It's always a coordinated effort with our clients as well. So, we engage with a client. As I said, we have tax advisors, accounting advisors, whoever else that they want to bring into the fold, your legal team. We try to work as a coordinated team to provide all of that advice. So just in terms of this case study, then this is one of my favorite case studies. This is a company called Manufacturer's Edge. It was actually located in the New Jersey area. Again, I seem to do a lot of work in New Jersey. And we sold this company to a publicly held company called DXP. And I met this business, going back about 4 or 5 years. So this deal closed in 2024, but I probably started working with them in 2022. And, sometimes that introduction to a client and the timing of when to go to market, it can be immediate if it makes sense. It can be longer term if we decide that there are things that need to happen with that client. Maybe structurally, we need to do some changes. We need to perform a quality of earnings. We need to, how they have to grow into a valuation. Any number of those factors can dictate the time frame. But as you said, it's a process. So it's really sitting down with a client at the beginning and identifying, what are their objectives and what is the process, and then developing that process to align with the right timing. A lot of that can also be dictated about with the market. So what's happening in the market. So just to give you a bit of background on Manufacturer's Edge. So they were a distributor of plumbing products, specifically industrial and commercial fluid handling equipment. This is not a sexy industry by any means. If you think of the way that plumbing products are typically distributed, you've got your sales guy that walks down the street, goes to the OEM with a box of donuts, convinces them that they should allow them to distribute their product. And it was done like that for, probably the last 100 years. What Manufacturer's Edge kind of thought about was there has to be a more efficient way to do this, right? We can't just be sending our, sales people out to the OEMs and then convincing them to sell product. What we could do is we could optimize an electronic platform to bring more product in and then sell that out to a wider base of customers if we do it right. So Mike Karingi, who was the CEO in this case, came up with a digital first mentality. And his idea was if we create an e-commerce platform where we can put, in this case, it was about over 500,000 SKUs on this platform of plumbing products that customers can go to, and they can educate themselves on the particular product. They can probably make that purchase, connect with the OEM, and drop ship this product to the end user. So it's a great model. It's a very efficient model. You, in fact, can do this with about 20 people, as Manufacturer's Edge did, and be generating about 7 million of EBITDA. And that is what they did. So they use this platform, e-commerce platform, and what they did was they architected the catalog that would support all of the product. So as an end user, you would go onto the website, you would access the catalog, you would decide what product you would want. And then these salespeople were incredibly knowledgeable about the 500,000 SKUs that they carried and just understanding what the end user needed. And so they were able to answer all of the questions that that particular end user needed, and be able to sell them the right product. So what does that do for the OEM? That means there are no returns, right? So when a product was sold through Manufacturer's Edge, the return rate was probably less than 1%. So the OEM appreciated that as well. And then what you also have is that you have distributors that can work with some OEMs, but not other OEMs because there's a competitive angle to it. In this case, Manufacturer's Edge was able to work with a number of different OEMs, and there wasn't that competitive threat. So the business model itself turned the industry on its head. The industry had never seen anything like that, which then, brings up another point is, how do you value a company like this? Right? We can value a typical distributor, right? This is a very mature industry. People have been valuing distributors forever and a day. But how do you value a distributor that has 20 employees and is selling, an inventory of 500,000 SKUs and doing it, very successfully, generating 20 plus EBITDA margins? How do you value that business? And that's one of the number one reasons you would put a company through a process, because we don't value that. We do value the business. We give them initial value, but we let the market set the price, right? So that's the first thing you should understand about a process, is that as an investment banker, you don't dictate the value to the market. You let the market set the price. It's a competitive arena of buyers that don't know who else is in the process, right? They don't know if there's strategic financials, financial sponsors, and just to make sure people understand that. So you can have a strategic company like DXP. You could have a financial sponsor that owns a platform company, and that is a portfolio company. And then you could also have just a financial sponsor that invests in that business as the platform. So you can have 3 different buyer constituencies. But the point is, it's a competitive process. Nobody knows who's in the process, and nobody knows who else is bidding or what they're bidding. So that is a typical sales process. And what that does is it affords the seller the opportunity to meet with all of these potential buyers, but the buyers don't know who else they're meeting with or at what price that deal is ultimately priced at. So I think I provide enough on the background of the business. We were engaged as an investment banker to come in and run a process for this particular for this particular seller. And we can go to the next slide and I can kind of walk through a bit of how that process unfolded. So I did mention that this company was based in New Jersey. It was Farmingdale. And they did build out this great distribution platform, which again was world-class. They were doing just under 40 million of revenue and just about 7 million or so of EBITDA. So, about 20% EBITDA margins. They actually grew as we were in the process and became even more efficient by putting in an OEM system, which was really, really great. And actually an ERP system that worked with their OEMs. And so their efficiency levels continued to rise. But what we ended up doing was we went out to about 150 potential buyers. We distributed 100 SIMs, which I'll talk about. And then we ultimately received 7 letters of intent. So just to step back and explain kind of what I mean by that. How do we identify, a buyer group, or that base of buyers? We use a number of different methods. So we look at our own internal network. We have 2,500 corporate finance professionals worldwide. And when we do sign up a new deal, we will go out to all of those 2,500 corporate finance professionals, solicit ideas of buyers worldwide. Now, sometimes it could just be a domestic transaction, which is fine, but we want to make sure that we tap into all of the experience that our 2,500 corporate finance professionals have had in identifying potential buyers that would be appropriate for this type of company. We don't disclose the company name. We don't disclose, where they're headquartered. All we tell our counterparts is that we have a client that is in the distribution space, plumbing distribution, and that, in this case, they have a digital platform to distribute their product. And that's enough information for our counterparts to understand, okay, who would be a good fit for this company. So we solicit their ideas. We also go through our database of buyers that we've been out to on all of our distribution deals and the relationships that we have and all the private equity relationships that we have. So we probably screen, I would say, somewhere between 300 and 400 potential buyers to come up with the 150 buyer list. I should also point out that number, that 150 buyers, it's not a targeted number. We're not trying to just add buyers for the sake of adding buyers. We don't want in any way compromise or taint the company. So we could be working with, I had a situation actually down in Florida where I had a seller. We only went out to 8 buyers. There were only 8 buyers for that business. It wasn't applicable to financial sponsors. So it was just applicable to the 8 buyers that we identified, and we got a deal done with the 8 buyers. So in every situation, you could be going out to 20 buyers, 100 buyers. We have a deal right now, we're going out to 300 buyers. So it's working with the client to understand, what limitations do we have? How do we protect confidentiality? Because that's the number one concern for middle market companies, is that we don't want in any way let the industry know that we're selling the business, because that could compromise relationships with our employees, with our customers. We are able to maintain confidentiality throughout the process. And the way we do that is we will go out to 150 buyers, but we do that on an anonymous basis. So the buyers do not know who the company is. We do provide an overview. It has a project name. We generally describe what the company does. We provide an overview of their financial profile, but we do not share the name. We only share the name once we have discussed the opportunity with the buyer. That buyer has indicated that they'd like to move forward. They've signed a non-disclosure agreement, and we are now moving forward to give them the SIM. So that I think in this case, we went out to 150 buyers. We actually distributed 100 SIMs because this particular deal was oversubscribed. It was really, I think an optimal time to be putting this company into market, because it was just following COVID. There weren't a lot of businesses that were entering into market because they were kind of dealing with the aftermath of COVID. And so we had a scarcity situation. We had so much demand from buyers, but we didn't have enough sellers, which is actually the same situation we have today. So for business services companies, I would say that we have scarcity premiums that are being afforded to those clients, in today's market. And that's exactly what we saw with Manufacturer's Edge. So the SIM I'm referring to is what's called a confidential information memorandum. So that's about somewhere between a 30 and 50-page deck, and it provides the buyer with all the information, non-confidential information, that they would need to develop a valuation on that particular business. We work together with the client to make sure that we're not distributing any competitive information, anything that would compromise the business in any way, shape, or form. And as I said, the buyer will sign a non-disclosure agreement. So in this case, we went out to 150 buyers, distributed 100 SIMs. We received, of the ones that the buyers that reviewed the opportunity, we received 29 indications of interest. So what is an IOI, or an indication of interest? That is when, based on the information that we've shared with the buyers, they have gone through preliminary due diligence, just reviewing the SIM, asking us questions. We may get questions that we have to go back to our client to receive answers from. We receive those answers, provide that to the buyer, and then they will give us their initial valuation of that business. So we received 29 of those. And if we go to the next slide, Brittany, I think we have this kind of chart it out. Actually, we'll go to the next slide after this, but this is a great slide because this actually shows you how we move from one buyer to the next. We start out with that 150 buyers. This isn't the full list, but certainly representative of it. We move to 25 plus buyers. Now they can understand, what the opportunity is, present us with indications of interest. We go through those 29 indications of interest with our seller, and we determine which are the best buyers for us to bring in for management presentations. And in this case, I think we had about 10 presentations that we move forward with those buyers. And if we go to the next slide, we can kind of see the range of value. So I love this slide because this is the same slide that we get in every single deal. It may not be 29 offers. In fact, actually, one of my colleagues just did a deal. He has an electrical contractor. He just received 35 bids on that deal, so more than this one. I think we actually hit a record with this one until he surpassed it with the last deal. But this is an excellent visual of where you see kind of the range of values that were received on this deal. Now, remember, all of these companies, all of the buyers receive the same information, but we have a $30 million delta on the valuation. So our lowest value came in at 34 million. The highest value came in at $64 million. And we probably value the company somewhere around that, $45 million range. So what you have is in every deal, you have a bell curve. You have your bottom fishers, which would be the 34 to 38 million, up to 40. You have your outliers, so those buyers that are somewhere between that 58 and 64 million. And then you have the valuation kind of in that middle value, anywhere between, I'd say, 45 and 55 million. That would be, quote, our BDO Capital valuation. If you went to market getting a competitive value, I will say that kind of 40 to 45 is if you go to market in a non-competitive value, right? So you are trying to sell it on your own. There is no competition. There's no reason for that buyer to pay more, and they know that you don't have any other options. So that's where you're getting that 40 to kind of 45. Then we start to move into the valuation that we ascribe to our clients. So we've gone through all of their financials. We've put together a valuation looking at a discounted value, valuation analysis, going through a comp analysis, a precedent transaction analysis. And by going through all of that, we get to that market value. And then ultimately, hopefully, we get outliers in our process that give us higher values. But that's not where it stops. So if we go to the next slide, we narrow that field. We go through management presentations. And now you can see the valuations that we received at the letter of intent stage. So another stage where we go through negotiations. I will tell you that those top 3 bids that you're seeing at 75 million, those were good bids from a valuation standpoint, right? We added about, I guess it was $11 million from the IOI stage. But what I should probably tell you is that what I didn't like about these bids when they first came across is they all had earnouts associated with them. So of the $75 million, in one case, we had a $20 million earnout. In another case, it was, between 10 and $15 million. And I was surprised when we got these bids in and we had the earnouts because we had specifically stated to the buyers that we didn't want an earnout. We weren't going to accept the earnout. And so when we received the bids, I didn't even share those bids with my client. I went back to the buyers and I said, we're not going to pass these bids along to our client, and understand that each of them doesn't know what other people have bid, right? So I'm having this conversation with each of the buyers. And I've said that unless you take that earnout out of your transaction structure, we won't even move forward in negotiating your bid with you. So it was a very stressful period for me because when I go into those negotiations, I'm hoping that they're going to come back with something better. I know they can't come back with something worse. So the least that I can get out of them is the same bid that they gave me but potentially I'm going to get something better, and even more potentially I could get, the ideal bid. In this case, two of the buyers came back, the P firm, the strategic, at 75 million with cash bids. So now we knew that we could negotiate those bids even further. And I was very happy that they changed the transaction structure. The P firm was actually a P firm that owned a strategic portfolio company. So there was going to be an equity role in that transaction. Very convoluted to do with leverage recapitalization. I would most definitely not try to engage in that on your own. It's a lot easier to do a straight strategic deal, which is what we did with DXP. So ultimately, my client had to decide, do I want to just take cash at close? In this case, we ended up negotiating it up to $80 million. Or do I want to sell my company but retain an equity portion, which would appreciate over time and could yield even a higher value above the 80 million. In this case, my client, which actually there were two business owners in the business that owned the business equally, 50%. They decided that the right deal was going to be with DXP, and they sold the company for $80 million. So when you kind of think of where we started, we had bids at 34 million. We valued them around that $45-50 million level, and then we sold it for 80. And the primary difference was here in this process that when we went to market, we had buyers telling us, how are you valuing this business? And we're like, well, we're not the ones telling you how to value it. You have to come up with that value. And I said, the market will value it. But I said, I think what we've created here, what this client has created, is the Amazon of pump products, right? You're coming to a distribution site where you can get inventory of over 500,000 SKUs. You can, in fact, get inventory on plumbing products that are obsolete everywhere else, but they're holding on to them because they don't, this is inventory that they don't need to have a warehouse to hold. It's drop shipping from the OEM. So that particular model is very much like the Amazon model, right? Come to Amazon, buy everything you need and don't have to go elsewhere. And so we were really driving them more towards an e-commerce valuation versus a distribution valuation. And it's through that process that a seller can get so much more value if your investment banker can position you the right way. It's probably worth an entirely separate call as to how we go about doing that. But that's that SIM I was referring to, where we put together this confidential information memorandum. We are going through an exhaustive effort to position the company the right way. And ultimately, that's worth a lot of money, right? I mean, we really got a great value. It was an 11 times multiple. The client was thrilled. The buyer was thrilled. It was a very competitive process. And we were just overjoyed that our client ended up with, a transaction structure that they're very happy with. So maybe I'll pause there and give us an opportunity for questions, or even Sarah, if you have any comments on that particular process.
Yeah, and this is great. I mean, I've seen a few of your case studies. I've not yet seen this one, but they're all very similar in the curve that you talked about, from the bid perspective and what you ultimately are able to negotiate as the final deal. Just a couple of points I wanted to raise here. I think it's important to drive home, especially with the type of business owner clients that we have, that you said it well when you said we don't value the company and put a price tag on it. Essentially, you have the situation where the market sets the price through that bidding process. And I think that when business owners who don't maybe have experience or exposure to investment banking, they look at it from a perspective of, I'll pay for a valuation, or, I think it's roughly worth this. And there's the feeling that they need to put the price tag on it. And that is not at all what your process is like, which is a driving factor as to why you can get such larger bids that come in based off of the market setting the price.
Yeah, that's a good point. I'll kind of reference another deal that I did where I think it almost exacerbates the impact that a process can have. But I have a client that was approached by a buyer. I did get engaged to do a one-off, which means we would just negotiate with that buyer. I don't like doing that for the reason that I just demonstrated. The best thing to do is go through a process. But it was an excellent company. This business was doing about 20 million of EBIT on 120 million of sales, and they received an offer for $124 million. The sellers didn't know what the value of the business was. And, they'd been running this business for 50 years. They were two gentlemen in their 60s. $124 million was a lot of money for them. But ultimately, I said, this is not the value of your company, but if you want to go down the path of this buyer, I'll do that. We tried to negotiate with that buyer. I think we got up to $155 million, but the increase from the 124 to the 155 was an earnout, which again, I don't like earnouts. I'll go on record saying I don't like earnouts.
No seller does.
Yes. We went to market and we ended up actually getting $210 million to the company. So again, a huge difference, right? That's about $100 million that you've created by going through the process. But that can happen because again, it was a unique business, difficult to value, but I think we valued the business at about 165 to 185 million. All of the values, incidentally, came in right around there. So I always feel like our valuation is very accurate. It's going, and where we see that is in that bell curve. So you'll see all the values kind of regressing around that, like the height of that bell curve. You can't ever value a business at the outlier stage because that's just the intrinsic value that a buyer puts on a business, right? So if I go into a relationship with a seller and that seller tells me that they're looking for a valuation that's in that outlier range, I'm not the banker for them because I can't guarantee that I will go to market and get multiple bids. I would also like to say that I referenced a couple of examples here for very large deals. Our deals go down to, 2 to 3 million of EBITDA and upwards. It just so happens that these case studies were good case studies to demonstrate how that competitive process works, but the same thing happened. I had a client in Florida. We valued them at 18 million. We got 30 million, right? So it can happen in every single situation. It is a process. It is kind of the process of going through a process to make sure that that happens. But as a seller, you are not responsible for setting the value of your company. I don't even know how you would go about doing that because everybody can use a financial methodology to value the business, but a lot of it is what we're seeing in the market today. And I keep referencing business services companies. It's because we're working on 3 business services companies right now. And every process that we've run, we've received so many competitive bids, and they've been far above what we thought that they would trade for. And it's because of the scarcity premium being afforded to business services actually today, like right now in this time period.
We did have one question come in, and it was around the cost structure of working with an investment banker. If you want to just give a little bit of color to how that works as well from the cost to the buyer.
Sure. So the seller pays our fee. The buyer is not involved in that at all. A typical investment banking fee, which is how we work and how most investment bankers work, is there's a retainer portion up front. So it's 25,000 for the first month, 10,000 thereafter. That is credited back against success fee. Again, we don't take on deals for retainers. We know if we're going to have a deal with a buyer within 60 days of going to market. So when I outline that whole process, when we enter into market to the point where we receive those IOIs, that chart where we had the 29 offers, that's a 60-day effort. And it takes us about 30 days to put together our information package for the buyer. So when you think about that, that's probably $45,000 investment that you're making to determine whether or not you actually have viable offers that you're moving forward with. The fee structure is around 1.5 million and up. So we will back into a percentage based on that. So that's kind of what I'm trying to get on a deal. When I say and up, we have incentivized fee proposals or flat fee proposals. So the incentivized fee would be a reduced percentage to get me to around that 1.5. And then there'd be an accelerator on anything over kind of that band that we believe we're going to trade at. I like that particular structure because I believe that the client and our team is aligned on our expectations, right? We want to get more. We always want to do that, whether on a flat fee or incentivized fee. But in this case, I think the client sees we're in the red on the lower end, And then it's not until we exceed the value that we value the company at that we actually will get into an accelerator. But like I said, I like that structure, but it's really up to our client. We give them a spreadsheet which compares the fee proposals. They're welcome to choose whatever they'd like.
So I just want to, we have about 10 minutes left. I want to talk a little bit about the current market conditions. You sort of sprinkled some of that in with the scarcity of business services. But I want to talk about what you've been seeing since, at the top of 2025, we have a new president. How is the situation with the economy and tariffs and interest rates affecting deals that you're seeing in the marketplace?
Yeah. Well, I am so glad that this session was this week and not 3 weeks ago or 5 weeks ago, because I think everything has changed in the last like 4 or 5 weeks. Let's just step back. We had the president come in last November, didn't really see the full effect of what he was going to do until Liberation Day, in February. And all of a sudden we had tariff policies completely turn the entire M&A market upside down. I had a couple deals that I'd put in market in the second half of last year, so right around that October, November timeframe. Thankfully, they did close. They closed at the end of March. We did not launch any deals in January through probably April of this year because of all the uncertainty, right? I think what's changed is a number of points. We now have more certainty around the tariff policy, right? We know what's happening. If you were a manufacturer and you were going to market, I don't know how you could value your business or a buyer could value your business because there was uncertainty. So do you know what buyers do when they can't value businesses? They discount the business. Right. So I would tell my clients, we're not going to market unless we know exactly what the impact of tariff policy is to your business, which is why everyone shifted to business services because there's no impact of tariffs. So it's kind of, triangulating. But what we have is now we have more certainty around the tariff policy. Just last week, 17th, what are we on, the 26th? So last week, the Fed cut interest rates by a quarter point. We did expect that to happen. We do expect another quarter point drop through the end of the year. What that's doing is reducing the cost of capital so buyers can increase valuations. It's giving more confidence to the overall market. And I just opened the Wall Street Journal up yesterday and it said Wall Street, M&A on Wall Street is heating up. So when you start to see that as a headline, you know that everything is happening in a positive trajectory. I will say that the middle market lags the bulge bracket. So we're going to see that now at the bulge bracket level, those billion-dollar deals, and it's going to start to trickle down into the middle market and the lower middle market. We've already seen that in certain sectors. So consumer and retail, business services, we're going to start to see it come back through for manufacturing, business, construction services as we move throughout the year, but very positive. And I would say that probably the other point I would make is, and what's going to drive a lot of the M&A, I've heard this referred to a number of different ways. So the silver tsunami, gray wave, it is the preponderance of business owners that are entering retirement age. And it's a huge number. And you guys have lived through, COVID, then well, first of all, you lived through the great financial crisis, then you lived through COVID, then you lived through, Trump's tariff policies. I mean, business owners are exhausted. They're exhausted and they want to take the remainder of, their good years and they want to actually experience their lives. And so selling their business is something that I think is important to them. There's a lot of seller readiness now, a lot of blocking and tackling that occurred in the first half of the year. Now businesses have kind of right-sized their ship. They have their ducks in a row and they're ready to go to market. So I think we couldn't be in a better place for market making right now.
That's great. I love good news, and that
I
is
love good news
definitely
too. Like I said, I'm
news.
so glad this didn't happen 5 weeks ago because I was a little bit skeptical, but now I'd have to redo my whole presentation because so much has changed.
So just to close us out, Valentina, what thoughts or words of advice do you have for business owners who might be, 5 to 7 years left in what they want to, put into their business as far as their time and their resources, that may be on the lower end of, the 2 or 3 million in EBITDA that still is within the range of working with you guys?
Yeah. So first of all, I don't think it matters what size your business is. One of my clients I could think they were in a Vistage meeting. They had those CEO groups. And he said the best advice he ever got from one of his colleagues was you should always be running your business as if it was for sale. So
Mm,
have a plan, have a 5-year plan. Maybe you are transferring your wealth to a family member that's going to take over the business. If you're thinking about selling to a private equity firm, understand you're not selling and walking away at close. That's a 3 to 5 year commitment right there. So understand what your horizon is in terms of wanting to exit, like actually be out of the business.
mhm.
Understand where we are in the market cycle. So, I said that we're kind of getting back to the bulge bracket deals. That's going to start to happen. So I would say for middle market, lower middle market deals, we're going to peak in the next 12 to 24 months. You want to sell at the peak, right? It's like selling your house. You don't want to sell when, the housing market has gone into, the doldrums. You want to sell when it's at the peak. So timing the market, understanding your horizon, looking at the metrics of your business, right? So how does your margin compare to publicly held companies or other businesses in your industry? You can do that through an investment banker. So I don't think it's ever too early to sit down with a banker and understand how your business is being valued and understand what you might do to create value in your business. And then it's execution, right? You've got to take the next few years to just execute on it, time the market, and then hopefully entertain options for exit strategies at that time. Could be an ESOP, it could be a number of different things. So there's just not one exit option for you. And I think that's the most important thing that sellers should understand.
And I think that it's so important that, we've just really scratched the surface with a lot of these conversations. I mean, I love the case study because it really highlights your process and it highlights the importance of working with a skilled professional like your team so that you do leverage the optimum outcome for yourself, your business, and your family. But we really only have sort of touched on everything that you can offer. And it's wonderful to have you join us today. You're a terrific resource of information. I know that our audience appreciates it. I appreciate it. If anybody who's on this call wants to be connected with Valentina, we can certainly put you in contact with her. I just want to thank you again so much for joining us today and providing this information and these case studies for us.
Yeah, no, I greatly appreciate it. And always a resource for you and your clients.
Thank you so much. And to our audience, if you have any future office hour ideas or topics that you want to share, we want to make these as valuable to you as possible. So please submit those to Brittany as well, and we can put those on our calendar for the future. Other than that, thank you for joining us this morning. Have a wonderful rest of your Friday and a safe and happy weekend. Thanks, everybody.